In this video, we cover accounts receivable and uncollectibles, or in other words, bad debts. Sometimes customers just don't pay what they owe. Here's a typical balance sheet, and we will be focusing inside the current assets section, which contains accounts receivable, reduced by an estimate for uncollectibles, or bad debts. Here is a real-world balance sheet, prepared by Caterpillar Financial Services for 2016. Caterpillar is the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Like all balance sheets, total assets equal total liabilities plus shareholders, or in this case, stockholders' equity. Caterpillar is actually two entities, a manufacturer and financial services. We will focus on the financial services entity because it is in this area where Caterpillar manages its receivables, called finance receivables on the balance sheet. These receivables, which total over $26 billion for 2016, are primarily comprised of receivables created when Caterpillar sells its products to customers and then provides customer financing. They comprise 78% of the total assets of Caterpillar Financial Services, and about 1/4 of the total asset amount when adding together the assets of both Caterpillar Financial Services and Caterpillar Manufacturing. These receivables are disclosed net, which means that they have been reduced by an estimate of bad debts. And Note 3, which we examine later in the video, will tell us more about those bad debts. To understand accounts receivable, we must first understand the principles of revenue recognition, or when should revenue be recognized on the income statement. The basic answer to this question under both US GAAP and IFRS is when the service is performed or the product is delivered. At a fundamental level, when you have done your job. That's when you are supposed to book revenue on the income statement. Sometimes cash is received before the job is done, and in that case, we book a liability called unearned revenue, which is converted to a revenue when the job is completed. Sometimes cash is received at the same time the job is done, like at a grocery store, and in that case, cash and revenue are booked at the same time. And finally, sometimes, in fact quite often, cash is received after the product is delivered or the service is complete, and in these cases, an accounts receivable is created and it remains on the balance sheet until it is removed, usually when the cash is ultimately collected from the customer. So in summary, an accounts receivable is created when cash is received after the service is completed or product is delivered, or stated another way, revenue is recognized before cash is received. The receivable increases assets on the balance sheet, and the revenue increases net income on the income statement, which is close to and increases retained earnings. For what kind of companies are accounts receivable important? Managing receivables is very important to financial institutions like American Express and Bank One because their business is making loans to customers. Receivables are also important to large manufacturing companies that own their own financial subsidiaries like Ford, Caterpillar, which we described earlier, and General Electric. These companies are actually part manufacturer and part financial institution. Telecommunications companies like AT&T, Verizon, and Comcast have to pay close attention to their considerable receivables because they provide services to and then bill a wide variety of people from all walks of life. Managing these receivables is an important part of their business. And finally, retail stores that offer their own credit cards, like Dick's Sporting Goods, have to keep close track of customer credit. Interestingly, in recent years, many retail stores have moved away from offering their own credit cards, selling the activity to financial institutions that specialize in managing receivables. The major problem involved in carrying receivables on the balance sheet is simple. Sometimes customers do not pay. Some of the receivables on the balance sheet will never ever be converted to cash. For example, the $26.2 billion receivables amount on Caterpillar's balance sheet is net of $343 million of expected bad debts, which is disclosed in Note 3 in the footnotes of Caterpillar's financial statements. Here it shows that the total amount of recorded financial receivables is $26.555 billion, reduced by expected bad debts of $343 million, leading to the balance sheet amount of $26.2 billion. Certainly, companies like Caterpillar do their best to minimize this problem by creating incentives to pay quickly, sending out reminders, creating collection departments, and sometimes even hiring collection agencies. But in the end, some of the receivables just never turn into cash. In Caterpillar's estimate, over $300 million worth, a little over 1% of total receivables. To give you an idea of how big this problem is, here are some stats taken from recent financial reports of 4 major companies. Bad debts as a percent of total receivables. While these percentages may seem small, from 1.1% to 4.6%, Verizon's 2016 accounts receivables balance was $17.5 billion, meaning that its bad debts were something like $805 million. Not exactly spare change. Turning back to our generic balance sheet, when we look at the gross accounts receivable number, in this case $350, we know that it is an overstatement of the amount of cash the company can expect to collect. However, we do not know how large the bad debts will be or which specific customers will not be paying. As a result, the bad debt amount must be estimated as of the balance sheet date. And there are 2 basic methods used to create the estimate. Aging, which provides an estimate of collectible or good receivables by analyzing the receivables on the balance sheet, and percent of credit sales, which provides an estimate of uncollectible or bad receivables by focusing on credit sales, which appears as a revenue on the income statement. Let's talk for a minute first about aging of receivables. Under this method of estimating bad debts, we first review the individual receivables and categorize them on the basis of their ages. For example, let's assume that we have a total $100,000 gross amount of accounts receivable on the balance sheet. Old receivables more than 30 days outstanding and new receivables less than 30 days outstanding. $30,000 in old accounts and $70,000 in new accounts. Based on our experience, we assigned a higher collectible percentage to the new ones, say 99%, and a lower collectible percentage to the old ones, say 98%. We can then estimate our collectible net balance in accounts receivable, $98,700, which becomes our estimate of the ending balance sheet amount. This means then that we have to reduce the $100,000 gross accounts receivable balance by the difference, which in this example is $1,300, and we call this difference the allowance. In essence, under aging, we estimate the collectible receivables and then compute the allowance or uncollectible receivable dollar amount. This method of estimating bad debts, the aging approach, provides close control over receivables management by focusing on the individual receivable accounts, the place where collection efforts should be directed. All companies that offer credit to customers should use this technique or something like it to keep close track of the age, condition, and collectability of their receivables. However, the next method of estimating receivables, the percent of credit sales approach, is more popular for purposes of financial statement reporting, primarily because it is much simpler, requiring much less detail. Unlike the aging method, which directly estimates the net accounts receivable amount or collectible receivables, the percent of credit sales approach directly estimates the allowance or uncollectible receivables, which is subtracted from the gross accounts receivable in the calculation of net accounts receivable. The estimate itself focuses on the credit sales of a given year, $100,000 in this example, which comes from the income statement, and simply multiplies the credit sales times a historical bad debt percentage, in this example 2.5%. In other words, of the $100,000 in credit sales recorded this year, we estimate that 2.5% or $2,500 will not be collected at the $2,500 estimate for the allowance. As indicated earlier, this method is widely used for estimating the bad debt amount used on the financial statements because it is simple, and further it represents an application of the matching principle because the bad debt expense for the year, which will result directly from the estimate, will be matched against the credit sales amount on the income statement of that same year. In the next section, we walk through an example showing how this approach is applied in practice.